Three waterways keep the world fed: the Suez Canal, the Panama Canal, and the Strait of Hormuz. And right now, all three are broken at the same time. What most people assume is a shipping problem is actually a food crisis, a financial crisis, and a political crisis all wrapped into one. And this is how it happened. About 80% of everything the world trades by volume crosses the ocean on a ship. Within that network, a small number of narrow choke points, some only 21 miles wide, act as the connective tissue holding the entire system together. When those passages get blocked, the damage does not stop at the port. It reaches grocery shelves, government budgets, and the financial stability of entire nations. Starting in late 2023, Houthi militants in the Red Sea launched sustained strikes against commercial vessels, and Suez Canal traffic collapsed. Daily transit volume dropped from roughly 4 million metric tons to just 1.7 million, a decline of nearly 57.5%. Container ship tonnage crossing the canal fell by 82%, which meant that the busiest trade corridor connecting Asia and Europe effectively shut down. Across the Atlantic, climate-driven droughts strangled the Panama Canal, which normally carries about 5% of global maritime traffic, and transit volume there dropped by almost 32%. March 2026 delivered the hardest blow. Joint U.S.-Israeli airstrikes on Iranian infrastructure provoked an immediate response from the Islamic Revolutionary Guard Corps, and commercial traffic through the Strait of Hormuz collapsed by 90%. A waterway that normally handles 138 vessels per day recorded as few as 4 transits in a single 24-hour period after the escalation. Hundreds of crude, LNG, and bulk carriers dropped anchor in the Gulf of Oman to avoid entering the choke point, and approximately 3,200 ships, representing 4% of global ship tonnage, sat idle inside the Persian Gulf. Every one of those stranded ships had to go somewhere else, and the only option left standing sat at the bottom of Africa, the Cape of Good Hope. Rerouting around the entire African continent adds 4,000 to 7,000 nautical miles and 10 to 20 additional days of transit time to standard voyages. Freight costs exploded as a result. Shanghai to Europe container rates jumped 235%. The Shanghai Containerized Freight Index surged 143% between December 2023 and early February 2024. War risk premiums for Red Sea transit climbed from under 0.1% to between 0.7 and 1.0% of a vessel's hull value. And in the Persian Gulf, those numbers reached 1.5 to 3.0%. Put that in real terms, and a supertanker valued between $200 million and $300 million suddenly faced insurance costs swelling from $625,000 to $7.5 million for one trip, a 12-fold increase that erased voyage profitability entirely. Here's the thing that separates 2026 from every shipping crisis before it. During the Iran-Iraq tanker war from 1981 to 1988, roughly 540 merchant ships took hits, but only about 2% of vessels passing through the Gulf faced disruption, and global trade kept moving. Producers discounted their oil prices to offset higher insurance, and naval escorts helped stabilize the corridor. None of that worked in 2026, because the blockade came from the insurance industry, not the military. Major P&I clubs, including Guard, Skuld, and North Standard, along with Lloyd's of London, canceled war risk coverage outright. Once a single transit cost $7.5 million in insurance on top of fuel and crew expenses, ships simply stopped moving. Financial fear outpaced any military deployment. And this is where it connects to the food on your table. Roughly 90% of all globally traded food and agricultural products travel by sea. Unlike electronics or auto parts, agricultural goods move in enormous volume at razor-thin margins, and many of them carry a biological expiration date that no amount of money can extend. A split runs straight through the agricultural supply chain that determines who survives a freight crisis and who does not. Storable grains like wheat, corn, and soybeans have a built-in shock absorber, the storage silo. When shipping costs surge, farmers and grain merchandisers can hold their crop in on-farm bins or commercial elevators and wait for the market to stabilize. A pricing signal called basis, the gap between the local cash price and the futures contract price, weakens when freight rates spike, and that signal tells producers to store rather than sell. Revenue gets delayed and financing costs climb, but the physical grain stays intact. Perishable goods enjoy none of that protection. Fresh produce, meat, and dairy demand an unbroken cold chain maintained between 0 and 5 degrees Celsius, and they must reach the market before biology takes over. Triple the cost of refrigerated transport, and the shipper either pays or watches the cargo spoil. When downstream channels collapsed during 2020 and 2021, dairy farmers dumped milk into waste lagoons. Produce growers crushed unharvested specialty crops back into the soil, and fruit rotted unpicked in orchards across the country. By 2026, carriers like CMACGM had halted all refrigerated container bookings to Iraq, the UAE, Saudi Arabia, and Kuwait, cutting off the supply line for high-value perishable agriculture to the Middle East entirely. Most people think of the Strait of Hormuz as an oil choke point, and it is, carrying roughly 20% of global petroleum and 20% of globally traded LNG. What almost nobody talks about is that 20 to 30% of the world's exported fertilizers also pass through that same narrow corridor, including urea, ammonia, phosphates, and sulfur. The Persian Gulf ships about 45% of global sulfur and more than a quarter of the world's urea. Drone strikes forced Qatar Energy to shut down urea, ammonia, and methanol production at its Ras Laffan complex, and Qatar alone accounts for roughly 11% of global urea exports. That shutdown landed at the worst possible moment, the start of Northern Hemisphere spring planting season, when demand for nitrogen fertilizer peaks. No country maintains a strategic fertilizer reserve the way oil-producing nations stockpile crude. Urea prices climbed 19% in 1 week, topping $590 per metric ton. About half of global food production relies on synthetic nitrogen, and fossil gas makes up 60 to 80% of the cost of producing it. When shipping costs explode, somebody has to pay. That burden falls with brutal inequality across the food chain. Picture an hourglass. Millions of small, fragmented farmers at the bottom, a tight cluster of massively consolidated trading firms and shipping alliances in the middle, and a concentrated retail sector controlling the top. Look at soybeans moving from the United States to China to see how this plays out. Dry bulk freight rates on that corridor surged 73%, and the cost split almost entirely against the producer. Soybean prices in China ticked up by only 0.9 cents per bushel, while prices paid to American farmers dropped by approximately 4.3 cents per bushel. Nearly 83% of the freight shock landed on the farmer. Chinese buyers, who could source alternatives from Brazil, refused to absorb the increase and pushed the entire cost backward. Bananas paint an even bleaker picture. Between 2001 and 2015, the producer's share of the banana value chain out of Ecuador plummeted from 16% to just 3%. Supermarkets treat bananas as a reference item for how consumers perceive store prices, and they will not raise the retail number. Every time freight costs climb, the squeeze travels backward to the plantation and the workers, where margins have already been stripped to almost nothing. Sitting at the center of this hourglass are 4 companies that dominate global grain trade: Archer Daniels Midland, Bunge, Cargill, and Louis Dreyfus, collectively known as the ABCDs. Together, they control an estimated 70 to 90% of global commercial grain trade. Along the U.S. Center Gulf, where roughly 2/3 of America's corn and soybean exports leave the country, they own 80% of port elevator capacity. Profit margins for these top traders tripled during the logistics crises from 2021 to 2023. Out on the water, the 3 largest shipping alliances hold more than 83% of global container ship fleet capacity. All of that concentrated power produces concentrated damage at the bottom. The World Bank tracked real food price inflation, exceeding overall inflation in 60% of 162 surveyed countries during 2024 and 2025. Low-income countries reported food inflation above 5%, in 78.9% of cases. Indonesian households at the lower end of the income scale spend up to 64% of their monthly earnings strictly on food, which means even a small uptick in the landed cost of imported grain creates a direct cost of living emergency for millions of people. Importing nations face a second wave of damage through their exchange rates. As the food import bill swells, governments burn through foreign currency, mostly US dollars, to pay for staples, and that drives their own currency downward. What happens next is a self-reinforcing loop. Lao PDR offers a clear example, where data showed that a 1% month-on-month CPI increase explained about a 0.34% increase in the following month's inflation, and a 1% widening of the gap between parallel market and commercial bank exchange rates pushed the next month's CPI up by 0.14%. Once depreciation starts feeding back into prices, inflation becomes sticky and self-perpetuating. Central banks find themselves trapped. Raising interest rates cannot reopen a maritime choke point or bring freight costs down, but standing still risks letting inflation expectations spiral. Bank Indonesia charted a different course through this crisis and succeeded. Rather than leaning on blunt rate hikes, BI ran a triple intervention strategy across offshore non-deliverable forward markets, onshore domestic NDF markets, and direct spot market transactions, while deploying specialized securities, SRBI, SVBI, and SUVBI, to attract foreign capital and absorb excess liquidity. Despite the shipping chaos surrounding it, BI held CPI inflation inside the targeted 2.5% plus or minus 1% corridor, and core inflation stayed locked between 2.19 and 2.45%. Governments are spending enormous sums to hold the line. Indonesia set aside $9.36 billion for food security in fiscal year 2025, and the state logistics agency Bulog received $1 billion to procure 3 million tons of rice. Through a program called the Cheap Food Movement, subsidized rice reached 7,285 sub-districts across the country. The Philippines took a different approach, more than doubling its 2026 farm-to-market road budget from 16 billion pesos to 33 billion pesos to build 2,750 kilometers of new roads, while the Philippine Senate allocated 2.4 billion pesos for deep-water ports. Not every country can sustain that kind of spending. Zambia's Food Reserve Agency consumed 17% of the entire national agricultural budget. Pakistan's wheat reserve loans carried interest rates up to 20%, leaving $900 million in unpaid liabilities and forcing the government to halt procurement entirely. The 2026 Hormuz closure also triggered a phenomenon traders call soy meal washouts. Brazil and Argentina lead the world in soybean meal exports, but with the Strait of Hormuz blocked, trading houses started canceling physical deliveries and settling the difference in cash instead. Stranded soybean meal began piling up at South American export terminals, driving local prices sharply downward, while the Middle East simultaneously ran short of animal feed, threatening meat and poultry production across the region. Past crises offer a clear warning about what not to do. During the 2007 to 2008 food crisis, dozens of major producers panicked and imposed uncoordinated export bans on staple grains. Those protectionist moves did not prevent the crisis, they accelerated it. Export restraints added directly to the spike in international prices for rice, wheat, maize, and oilseeds, and the countries that depended on imports suffered the worst. That failure produced two lasting reforms. The G20 established the Agricultural Market Information System in 2011, creating a transparent, real-time database of global crop stocks that helps prevent the kind of speculative panic that drives governments to hoard. The ASEAN +3 Emergency Rice Reserve replaced the failed 1979 ASEAN Reserve, which had only 50,000 tons and recorded 0 releases during its entire existence. With a multi-tiered system built specifically to bypass commercial shipping failures. New physical infrastructure is also reshaping trade routes in response to the crisis. The Capricorn Bioceanic Corridor, a 2,396-kilometer transcontinental highway linking Brazil's agricultural heartland to Pacific ports in northern Chile through Paraguay and Argentina, has shifted from a long-term infrastructure concept to an urgent operational necessity. Estimates put its annual capacity at over 8.6 million tons of products, generating more than $3 billion in economic impact across agriculture, pulp, and meatpacking. Freight costs could drop by 30 to 40%, and shipping times to Asian markets could shrink by up to 15 days. Brazil's adoption of the TIR customs transit system, entering force in July 2026, aims to cut overland inspection times by up to 92%. The financial plumbing of global trade is straining under the same pressure. Letters of credit, the standard payment security instrument in agricultural trade, are failing at alarming rates, with 60 to 80% rejected on first presentation due to discrepancies. When a voyage stretches from 20 to 45 days, a trader's working capital sits frozen for more than twice as long, effectively halving their ability to open new trades. Small and medium enterprises face the worst squeeze, with credit line utilization rates hitting 94%. The Grain and Feed Trade Association, whose contracts govern roughly 80% of global grain shipments, updated its standard forms in October 2025 to account for this new environment. Workable solutions do exist. Digital unconditional cash transfers rank as the most cost-effective intervention, bypassing physical shipment bottlenecks entirely and delivering assistance at roughly $7.30 per dollar, compared to $14.35 for physical voucher programs. Tariff liberalization directly reduces the landed cost of food. Rice tariffication in the Philippines produced a 17% price decline that benefited the poorest households the most. Parametric insurance, which triggers automatic payouts when a vessel stays delayed beyond a preset threshold, provides immediate liquidity to traders without months of claims processing. Cheap, frictionless global food logistics belong to an era that has now ended. The system that kept the world fed relied on a single assumption, that narrow waterways connecting oceans would stay open and peaceful, and that assumption has collapsed on every front. The global food import bill reached $2 trillion. Three staple crops, wheat, maize, and rice, account for almost 2/3 of the world's dietary energy needs, and just 6 countries supply 70% of them. Over half of the exported supply of those crops travels maritime routes that are now compromised. Redesign is already underway, through overland corridors, digital trade finance, parametric insurance, and targeted cash transfers. Whether that redesign outpaces the next crisis will determine the difference between manageable disruption and a full-scale humanitarian emergency. The countries and companies that learn to operate at the intersection of physical supply and financial resilience will shape the next decade of global agriculture. Those that do not will pay a cost measured not in dollars, but in hunger.